So I think volatility is here to stay for a couple of reasons, right? Political risk is very hard to price in. You've got binary outcomes, as you talked about, flight to quality with everything going on in Ukraine. Plus, we've got a Fed that is admittedly nimble. I mean, Chair Powell uses the humble, nimble phrase, which means that, they've left the 50 basis point hike further down the road on the table. He specifically brought that up last week. So the market has to price in the probability that if inflation doesn't decelerate, as the Fed is expecting, maybe the Fed has to speed up the pace of hikes or that they can be more aggressive on quantitative tightening. So we've got a hiking cycle that we're about to embark on next week, in our view, without forward guidance. And that's what marked the last two hiking cycles. And then I have to say inflation is inherently uncertain, very hard to forecast. And now you've got tighter financial conditions and how that's going to feed through into the economy. So there's a lot going on. So I would say volatility is here to stay. We are, though, expecting that the Fed will start to raise rates because we're at zero. So they're going to argue that the economy can handle some rate hikes. So we expect, interest rates to rise. I think the rate hikes that are priced in are fair, very much in line with what we're looking for. It's quantitative tightening, and any talk about that next week, and we think the Fed starts that, that's going to push longer end rates higher. I think more on the real rate component rather than inflation. But I do think the 10 years is likely to continue to rise, even with the stagflationary shock that we're living through.
What about credit risk, Priya, which we have seen rise, and we are paying attention to it? What is the signal you're getting from corporate bonds right now?
Right. So I think we're seeing the risk premium going up. We're also seeing the market pricing in greater credit risk because of exposure. And, I should say there's the direct exposure to Russia, Ukraine, but then there's the indirect exposure to Europe or European banks or somebody else who might be exposed to Russia. So, I think the knock-on effects are still being felt. It's an illiquid market. There's not a ton of price discovery. I am worried about credit, particularly because there's no clear policy backstop to credit. And, I think that widening is likely to continue. The one place where we've seen it in the rates market is in the very front end. We're seeing dollar funding pressures showing up. That's where I am a little less concerned because we have central bank swap lines. We have a lot of liquidity in the system. So I'm less concerned about overnight and 3-month CP. But credit spreads, I think all risk assets are getting repriced to cheaper levels, and credit is part of that.
Yeah, well, it's reassuring you don't see too much of an alarm in the short-term funding markets. I do wonder what your read is on the Treasury yield curve. Sarah was mentioning earlier, it's compressed down to about a 0.25 percentage point between the 2 and the 10-year. Now, on the one hand, that seems very flat as the Fed starts to hike rates, but on the other, that 2-year yield would seem to incorporate several rate hikes to come. So, what's the takeaway?
I think the flat curve is telling you the market's really concerned that the Fed might overdo it, because they're nimble, inflation's high, so do they raise rates too much plus do a lot of QT and have to reverse course? Because the consumer would be dealing with, not just higher mortgage rates, lower stock prices, as well as higher prices for everything they're paying for. So I think that's the fear, which is why the yield curve is pricing in rate cuts. For the first time in the last month, we've actually priced in cuts in 2024. So the market's saying the Fed will raise rates this year, next year, and then they'll have to turn around and cut rates. And I'm hoping that the dot plot next week or Chair Powell can talk about how they're going to try very hard to achieve this soft landing and not overdo it. And if it means pausing in this hiking cycle, this need not be a series of rate hikes. It might be more volatile, but in the process, they prevent that overdoing or policy mistake idea. I think the yield curve is telling you that the Fed might make a policy mistake, and I think as a policymaker, they really want to push back against it because that's very negative for risk assets as well as the economy if the Fed pushes us into a recession.